If you are looking at your portfolio today, you might be wondering why the rules of gravity no longer apply to the market. The January jobs report dropped a bombshell that completely wiped out expectations for a March rate cut. That shockwave immediately moved into the bond market and pushed yields significantly higher. But instead of crashing, commodities are staging a historic and aggressive breakout. Stick with me, and by the end of this, you will understand why silver is the most important chart in the world right now, and how you can position yourself for this massive shift. Let us start with the macroeconomic reality check that hit the tape this morning. The headline number that everybody was waiting for was the January employment situation report. The United States economy added 130,000 new payrolls last month. That number is nearly double what Wall Street economists were expecting. On top of that, the unemployment rate actually dropped to 4.3%. In a normal vacuum, this is an absolute victory lap for the economy. It shows resilience. But for the stock market right now, it is a massive complication. Traders came into this week pricing in a 22% chance that the Federal Reserve would cut interest rates in March. After this jobs report dropped, that probability collapsed down to just 8% in a heartbeat. The bond market reacted violently and mechanically. The 10-year Treasury yield pushed up to 4.18%. The message from the bond vigilantes is crystal clear. Higher for longer is no longer just a catchy slogan. It is the definitive operating system for the first half of 2026. If you are holding assets that desperately need cheap money to survive, this is your final wake-up call. Normally, when interest rates go up and the dollar gets stronger, commodities tend to go down. That is the textbook correlation. But that textbook is being rewritten today. We are currently in the middle of a massive structural revaluation of hard assets. Gold is holding very firm above $5,100 per ounce. But the real story, the one that is quietly reshaping global supply chains, is silver. Silver just surged to $86.8 an ounce. Some people think this is just a speculative bubble or a temporary inflation hedge. That is a common misunderstanding. This is not speculation. This is pure physics. We have been talking about the artificial intelligence infrastructure build-out for months. Everyone has been obsessively focused on the semiconductor chips. But high-performance chips generate heat. They generate massive, unprecedented levels of heat. If you do not control that heat, the chips slow down. To cool a modern AI server farm, you need the absolute best thermal conductors available. And the best thermal conductor on the periodic table of elements is silver. It transfers heat 7% better than copper. We are now seeing credible reports that major technology giants like Microsoft and Nvidia are bypassing the London Metal Exchange entirely. They are not waiting around to buy silver on the open market. They are signing direct offtake agreements with the mining companies to secure the physical metal before it ever reaches the public. They are doing this because they know the truth. There is simply not enough silver currently above ground to cool the massive data centers they are building. This is causing a historic supply squeeze. And it gets more complicated because of what we call the double loop effect. These AI data centers require an enormous amount of electricity to run. To meet that power demand, big tech companies are aggressively building out solar energy farms. Solar panels also require massive amounts of silver to manufacture. So you have a situation where silver is fundamentally required for both the computing chips and the power source. This creates a deeply price-insensitive buyer base. Tech giants will pay whatever it takes to secure their supply chain. The rolling recovery is still happening, but the leadership in the market has completely changed. Capital is rotating out of financial assets and expensive software. It is moving into the physical infrastructure that actually powers the AI economy. Before we go, a quick reminder. Everything discussed in this broadcast is for informational purposes only and does not constitute financial advice. Market investments carry risks. You should always do your own due diligence or consult with a certified financial advisor before making any investment decisions. If you found value in this deep dive, please smash that like button and subscribe to the channel. It helps us keep the signal strong. Tomorrow, keep a close eye on the 2-year Treasury yield to see if the rate cut expectations shift again. Stay sharp, watch the yields, and respect the trend. This is Wilson signing off.